Hi, and welcome to Accounting for Business Decisions A. For today's topic, we will be discussing what is a bank reconciliation and why they are important for making business decisions. A bank reconciliation is the process of reconciling the differences between the. More importantly, a bank reconciliation is the process of recognizing and noting the differences between the cash balance on a bank statement and the cash balance in a company's records. There are 3 steps to a bank reconciliation, and they are prepared as follows. First is to reconcile the bank balance to the actual cash balance. Secondly, it's to reconcile the company's book balance to the actual cash balance. And 3, it's to adjust the company's book balance to the actual cash balance. The first step is to adjust the cash balance reported on the bank statement to the company's actual cash balance. It will generally need adjusting for 2 reasons. First is deposit in transits. Deposits in transits have been made by the company but have not been cleared by the bank as of the statement date. These should be added to the bank's cash balance. An outstanding check is a check that has been distributed by the company but has not been cleared by the bank as of the statement date. Since the cash is no longer in the bank, outstanding checks should be subtracted from the bank's cash balance. Any other bank errors that have occurred will result in the need to either add or subtract from the cash balance. The second step in a bank reconciliation is to adjust the balance reported on the company's record to the actual cash balance. You can add any credit memorandums to the cash balance on the bank statement for items such as the collection of interest, and then deduct debit memorandums from the cash balance such as service charges, bank fees, and then bank errors are also added or subtracted. The actual cash balance per bank statement and the balance per company's records. The third step in a bank reconciliation is to record the journal entries necessary to adjust the company's book balance to the actual cash balance. These are based on the credit or debit memorandums and any errors. First is the collection of a receivable. In a collection of a receivable, cash is debited and accounts receivable is credited. 2. When correcting an error, cash is debited and accounts payable is credited. 3. When recording an expense such as a monthly service charge, you debit the expense and credit cash, decreasing both assets and equity. 4. When a check is returned for a non-sufficient fund, you debit accounts receivable and credit cash to reinstate the customer's receivable. In doing so, we treat each item that explains the difference as if it was the only reason our records and the bank records are different. The benefit of reconciling the bank statement is knowing that the amount of cash reported by the company's books is consistent with the amount of cash shown in the bank's records.
Created using Powtoon.